So in today's class, we are going to discuss secondary adjustment. When you hear secondary adjustment for the first time, you will feel a bit strange. That's fine, but listen till the end, you are going to get the clarity. Okay. So what is primary adjustment and secondary adjustment? The thing is, when we calculate arm's length price, difference between arm's length price and actual price, whatever is there, that we call as primary adjustment. Okay, I will take one example and explain so that you will understand better. There is a Sanjay Limited, there is Sahu Limited. Sanjay Limited is basically an Indian company. Sahu Limited is based in Dubai. So Sanjay Limited sold goods to Sahu Limited. Sale price is 12 crores. Arm's length price is 16 crores. So how much is the difference? Difference between arm's length price and actual sale price is 4 crores. Whatever this difference is there, 4 crore rupees. This 4 crore rupees we call as primary adjustment. Are you able to understand? So total income to be increased by 4 crores. Whatever this 4 crores is there, this 4 crores we call as primary adjustment. This 4 crores is also called by another name, excess money. Now the point is, whatever the excess money is there, primary adjustment. Like Sanjay Limited sold goods for 12 crores. But how much is arm's length price? 16 crores. That means how much is extra amount? Extra amount is 4 crores. Whatever extra amount of 4 crores is there, what Nirmalama is saying, what income tax department is saying, primary adjustment is 4 crores. On 4 crores you will pay tax. But 4 crores amount is not brought to India na. Generally, when foreign currency comes to India, Indian rupee value increases. Here, you sold for 12 crores, but actually you should sell it for 16 crores. That means you have done under sales 4 crores. Whatever 4 crores under sales that you have done, that is increased by income tax officer. Total income is increased by 4 crores. That is primary adjustment. Now Nirmalama is saying, income tax department is saying, whatever the excess money 4 crores is there, you should repatriate it to India within 90 days. That is called as secondary adjustment. Are you able to understand? Primary adjustment is increasing total income. Secondary adjustment is increased total income should be repatriated back to India within 90 days. Now you will feel strange. Sir, actually I sold for 12 crores only to get rid of headache from income tax department. I accepted arm's length price 16 crores and income tax department increased my total income 4 crores. Now income tax department is also asking me to bring that extra 4 crores to India. From where should I bring 4 crore rupees to India? Income tax department is saying, I don't know. You have to bring excess money of 4 crores to India within 90 days. If you do not bring excess money of 4 crores to India, it will be deemed as Sanjay Limited gave deemed loan to Saho Limited of 4 crores. And on that 4 crores, every year interest income will be calculated and interest income will be added to total income of the SSC. Are you able to understand? Sir, what is this, sir? It is very strange. Yes, I accept it is strange only. Okay. What the department is saying, whatever the primary adjustment amount is there, whatever the excess money is there, you have to repatriate excess money to India within 90 days. If you do not repatriate, if you do not bring that money to India within 90 days, they will deem you have given 4 crore rupees as loan to Saho Limited, and on that deemed loan, every year they are going to calculate and add interest income to your total income. That is the provision. That is secondary adjustment. It will appear strange, but accept the truth. We can't do anything. That is the provision. Okay. So the thing is, whatever this excess money is there, this excess money that should be repatriated repatriated to India within 90 days. What if you do not repatriate? You do not bring back that 4 crore rupees to India. Otherwise, else, excess money will be deemed as loan given to associated enterprise, and interest income will be added to total income of SSC till such excess money is repatriated to India. Repatriated to India. That means what? If you bring that 4 crores after 5 years, for all these 5 years, every year interest income will be added on 4 crore rupees to your total income. Sir, what is the interest rate? All that I will discuss little later. But you got clarity, right? You got understanding, right? Sometimes the students will also get doubt. Sir, here you took example of sales. What if the nature of transaction is purchases? See, any international transaction, whenever arm's length price is calculated, due to arm's length price, if total income is increased, whether it is sale transaction or purchase transaction or allocation of cost, any transaction, service transaction, because of arm's length price, if your total income increases, that is called as primary adjustment. Primary adjustment amount should be repatriated to India within 90 days. Otherwise, it will be deemed as loan given to associated enterprise, and every year interest income will be calculated, and such interest income will be added to total income of the SSC. Are you able to understand? Now, whatever this secondary adjustment is there, secondary adjustment provisions are applicable only if primary adjustment is more than 1 crore. Okay, now I'm discussing conditions. Here, primary adjustment is greater than 1 crore. So, secondary adjustment provisions are also applicable. Are you able to understand? If primary adjustment is less than 1 crore, secondary adjustment is not applicable. So, very clear. Sir, in every transaction, whether secondary adjustment provisions are applicable? Answer is no. Only if primary adjustment amount, excess money, only if it is more than 1 crore, then only secondary adjustment provisions are applicable. Otherwise, secondary adjustment provisions are not applicable. Next. Whatever the secondary adjustment provisions are there, they are applicable in 5 cases. So only in 5 cases, secondary adjustment provisions are applicable. In remaining cases, secondary adjustment concept is not applicable. I hope by this time you got a rough understanding about secondary adjustment. Now I'm going to discuss the 5 cases where secondary adjustment provisions are applicable. Okay, so condition 1, secondary adjustment provisions are applicable only if primary adjustment is more than 1 crore rupees. Second one, secondary adjustment provisions are applicable only in 5 cases. What are those 5 cases? I am going to discuss right now. Okay. Secondary adjustment applicable only if primary adjustment is due to 5 reasons. What are those 5 reasons? We are going to discuss one by one. Okay. Reason 1. If primary adjustment is done by SSE on suo moto basis. Yesterday we have discussed. arm's length price should be first calculated by SSE only on self-assessment basis. So if SSE himself calculates arm's length price on suo motu basis, then he will calculate primary adjustment. If primary adjustment is more than 1 crore, secondary adjustment provisions are applicable. He need to bring excess money to India within 90 days. Are you able to understand? I calculated actual sale price is 12 crores. Arm's length price is 14 crores. Now how much is primary adjustment? 2 crores. As primary adjustment is more than 1 crore, the 2 crores should be brought to India by me within 90 days. Should be repatriated to India within 90 days. Sir, 90 days are to be calculated from which date? That I am going to say right now. So the thing is, excess money, listen till the end concept. We will solve one problem. The moment we solve that problem, you will get complete clarity. You need to have patience because you are at final level. You cannot expect everything to be understood in just 2 to 3 minutes. Okay, international transaction, transfer pricing, many complex provisions are there. I am taking time. I am trying to impart in a very smooth way to you. So once I explain all the provisions, I'll make you solve one problem. You will get super clarity. Till that time, okay, please don't think I do not know the subject. Okay, have patience. Excess money to be repatriated to India within 90 days from this 90 days are to be calculated from ITR due date under section 139 subsection 1. Are you able to understand? That means generally in case of transfer pricing, ITR due date is 30th November. From 30th November, after 30th November, from 1st December onwards, okay, within 90 days, you have to bring back excess money to India. If you do not bring back excess money to India, then what is the recourse? Then excess money will be deemed as loan given to associated enterprise and interest income will be calculated. Are you able to understand? I will tell with one example. Let's say previous year 25-26 is there. What is ITR due date? Corresponding assessment year is assessment year 26-27. For 26-27, what is ITR due date? ITR due date is 30 November 2026. Starting from 30 November 2026, calculate 90 days. December 31, January 31, February 28. So 28th February 27. Exactly 90 days. Okay. Next. If excess money not brought to India on or before 28th February 27, then what is the situation? Excess money will be deemed as loan given to associated enterprise and interest income will be calculated. For example, excess money brought after 115 days. Now my question is, ITR due date is 30th November. After 30th November, within 90 days excess money is not brought. After 115 days excess money is brought. My question is, interest calculation. Whether interest calculation is done for 25 days. 25 days means what? Over and above 90 days or 115 days. What do you say? What is the answer? Whether interest is calculated after 90 days period or whether interest is calculated immediately after ITR due date. For 115 days, whether interest is calculated. Answer is interest is not calculated for 25 days. Interest is calculated for 115 days. That means you have to bring excess money to India within 90 days. If you do not bring excess money to India within 90 days, immediately after ITR due date, from that date onwards, interest income will be calculated. That means what? You have to bring excess money on or before 28th February 2027. If you do not bring, starting from 1st December 26, from this period, interest income will be calculated. Are you able to understand? So, if you violate the provisions, you have to pay interest. Interest income will be calculated. It will not be calculated after 90 days. It will be calculated from first day immediately after the ITR due date. Are you able to understand? So, an interest income will be calculated from ITR due date under section 139. Write down here. So within 90 days, bring back excess money. If you do not bring excess money within 90 days, starting from first day after ITR due date, interest income will be calculated to you. Are you able to understand? See how much complexity is. Seriously. Don't worry, I will tell one example, you will get clarity. Next. What will be the interest rate on excess money? To calculate interest income, we need to know interest rate, right? What is the interest rate? That I am going to discuss with you. I hope till now you got clarity, you did not miss the flow. Excess money to be brought to India within 90 days if you do arm's length price calculation on suo motu basis. If you do not bring within 90 days, interest income will be calculated. From which date interest income will be calculated? Interest is not calculated after 90 days onwards. Interest will be calculated from first day immediately after ITR due date. Are you able to understand? Now, to calculate interest income, we need to know interest rate. That interest rate I am going to discuss with you. If transaction is denominated in Indian currency, we will calculate interest rate in one way. If transaction is denominated in foreign currency, denominated in foreign currency, then we will calculate interest rate in different way. If transaction is denominated in Indian currency, then interest rate is SBI 1 year marginal cost of lending rate as on 1st April of previous year plus 3.25%. So every year SBI will release marginal cost of lending rates. As on 1st April of previous year, whatever SBI marginal cost of lending rate is there, take that rate, to that add spread 3.25%. Whatever the total rate is there, that is the interest rate. If transaction is denominated in foreign currency, then 6 months LIBOR, you know LIBOR, right? London Interbank Offered Rate, 6 months LIBOR as on 30th September of previous year. To that you need to add 3% spread. That is going to be the interest rate. Sir, we understood. We need to calculate SBI 1 year marginal cost of lending rate as on 1st April of previous year, 6 months LIBOR as on 30th September of previous year. For which previous year we need to consider? You need to consider for the previous year in which interest income is calculated as per secondary adjustment. So, like, you did not bring excess money for 4 years. Every year you will calculate interest income, right? Each year, as on 1st April of that year, whatever the SBI marginal cost of lending rate, whatever 6 months LIBOR is there, those rates you have to consider and you have to calculate interest income. Are you able to understand? Next, I already told you secondary adjustment is not applicable if primary adjustment is more than 1 crore. So, no secondary adjustment. No secondary adjustment. If primary adjustment is primary adjustment in any previous year is less than or equal to 1 crore. Second, if primary adjustment is for assessment year 16-17 or earlier assessment years. Earlier assessment years. Because this concept of secondary adjustment was introduced post assessment year 16-17. So assessment year 16-17 or before, even though primary adjustment is more than 1 crore, secondary adjustment provisions are not applicable. Are you able to understand? So simple, only if primary adjustment is more than 1 crore, then only secondary adjustment is applicable. That too from financial year 16-17 onwards. Assessment year 16-17 means financial year 15-16. Financial year 15-16 or before, secondary adjustment concept is not applicable. Secondary adjustment concept is applicable only from financial year 16-17 onwards. That too if amount of primary adjustment is more than 1 crore. Okay. Now, students will get doubt. Sir, tell me practically from where to bring that 4 crores? Who will give that 4 crore rupees? Of course, Sanjay Limited sold goods to Saho Limited. But from where Saho Limited can give 4 crore rupees? Here one thing, not only Saho Limited, if Sanjay Limited has any other associated enterprise in Australia, New Zealand, Africa, even that associated enterprise also can send 4 crores. Not only the person with which you do the transaction. No, any associated enterprise can repatriate 4 crore rupees to India sufficient. Secondary adjustment will not be done. But the thing is, here we sold goods for only 12 crores. He calculated arm's length price 16 crores. From where Saho Limited will give 4 crores, from where Sanjay Limited will bring 4 crore rupees. Sir, is there any option available? Because there is no way that they can bring 4 crore rupees. There is solution. There is second option. First option, you repatriate 4 crores to India. Second option, if you do not repatriate 4 crores to India, you have to pay additional income tax. If you pay additional income tax, they will not do secondary adjustment. Are you able to understand? Now, how much is additional income tax? That we will see. So basically, how many options are there? Two options are there. Two options. Option 1, bring excess money to India. Bring excess money within 90 days. Else, secondary adjustment will be done. You know secondary adjustment, right? Excess money will be deemed as loan given to associated enterprise and interest income will be calculated. It will be added to total income of SSE till the time that excess money is brought to India. This is option 1. What is option 2? To avoid secondary adjustment, you can pay additional income tax. Pay one time additional income tax on excess money at the rate of 20.9664 percentage. Are you able to understand? What is breakup for this 20.9664%? Breakup is tax 18% plus surcharge at the rate of 12% plus HEC at the rate of 4%. The moment you pay additional income tax, from the date onwards, interest income will no longer be calculated. Secondary adjustment will not be done. Are you able to understand? So very simple. Whenever primary adjustment happens, if primary adjustment is more than 1 crore, you are left with two options. First option, repatriate excess money to India within 90 days from ITR due date. Else, interest income will be calculated. Interest income will also be calculated from ITR due date until the time you bring back excess money to India. Option 2, you pay additional income tax at the rate of 20.966%. If you pay additional income tax, department will leave you. It will not calculate interest income. It will not do secondary adjustment the day on which you have paid additional income tax. After that date, they are not going to do secondary adjustment. Are you able to understand? So this is the provisional part. Now we are going to solve one problem. With this problem, you are going to get clarity. Don't worry, I am going to share this PDF with you, so everything is available on your hand only. But before we do, first let us read the question. There is a Share Limited, an Indian company. Share Limited holds 36% shareholding in Peddi Limited, USA. Okay, Peddi Limited is not Indian company, it is US based company. In previous year 22-23, Share Limited sold 6 crore worth of goods to Peddi Limited. Arm's length price on suo motu basis is 8.2 crores. SBI marginal cost of lending rate as on 1st April 23 is 11.25%, 1st April 24 12%, 1st April 25 13%. Here transaction is denominated in Indian rupees, right? As transaction is denominated in Indian rupees, you have to take SBI marginal cost of lending rate as on 1st April of previous year. Additionally, you need to add a spread of 3.25%, correct? So, shall we solve this or take some 30 seconds of your time, pause the video, read the question clearly. So, when I'm explaining, you are going to understand it. Okay, shall I explain? Hello? First, we will plot the information. Answer. So, there is Share Limited and there is Peddi Limited. Share Limited is an Indian company. Peddi Limited is US based company. Share Limited holds 36% shareholding in Peddi Limited. So we can treat both entities as associated enterprises. Share Limited and Peddi Limited as associated enterprises. Well and good. Now, how much are actual sales? Actual sales 6 crores. How much is arm's length price? Arm's length price is 8.2 crores. So how much is primary adjustment here? Primary adjustment, which is also called as excess money. Excess money is 2.2 crores, right? So here excess money is more than 1 crore. So whether secondary adjustment provisions are applicable? Answer is yes. Secondary adjustment provisions are applicable. Now, when this transaction happened? This transaction happened in 22-23. Well and good. For previous year 22-23, what is corresponding assessment year? Assessment year is 23-24. In 23-24, what is ITR due date? ITR due date is 30 November 2023. From this ITR due date, you have to calculate 90 days. So when 90 days will end? 28th February 24. On or before 28th February 24, excess money is to be brought to India. Are you able to understand? If excess money is not brought to India within 90 days, obviously it will be deemed as loan given and interest income will be calculated. But did he bring? No. Or did he pay additional income tax? No. When he paid additional income tax, he paid additional income tax on 1st July 2025. That means he paid additional income tax in previous year 25-26. Are you able to understand? So, in 23-24, whether additional income tax was paid? No. Whether excess money is brought to India? No. So for 23-24, you have to calculate interest income. Are you able to understand? So in the given question, excess money not brought to India before 28th February 24. As excess money is not brought to India before 28th February 24, it will be deemed as loan given to Petty Limited, and interest income will be calculated. From where interest income will be calculated? Interest income will be calculated from ITR due date under section 139(1). What is ITR due date under section 139 subsection 1? ITR due date is 30th November 23. That means technically from 1st December 23 onwards, interest income will be calculated. So December how many days? December 31 days. January 31 days. February 28 days. March 31 days. Total 31 plus 31 plus 28 plus 31. Total 121 days, correct? I think 2024 is a leap year. So February 29 days will be there. So interest income for previous year 23-24 is equal to excess money into interest rate into how many days? 122 days divided by 366 days. Okay. How much is excess money? 2.2 crores. What is interest rate? For 23-24, what is 1st April? 1st April is 1st April 23. On 1st April 23, how much is SBI marginal cost of lending rate? 11.25%. So you have to take 11.25%. Additionally, you need to add spread. How much is spread? 3.25% into 122 by 366. How much is interest income? 222 lakhs into 11.25 plus 3.25, 14.5. How much? 10 lakh 63,333. That is the interest income. Okay. This interest income will be added to total income of previous year 23. So are you getting clarity? Any doubts so far? So when additional income tax was paid? Additional income tax was paid on 1st July 25. That means additional income tax was paid in previous year 25-26. That means in 24-25 also we need to calculate interest income, correct? Interest income for previous year 24-25. Again same, you have to calculate excess money into interest rate. In 24-25 you have to calculate for total 365 days. So into 365 by 365, which is 1. Excess money is 2.2 crores into interest rate. We are calculating for 24-25. So we need to take SBI marginal cost of lending rate as on 1st April 2024. So 1st April 2024 SBI marginal cost of lending rate is 12%. So you will consider 12%. To that you will add 3.25%. So 12 plus 3.25, how much? 15.25, correct? 33 lakh 55,000. That will be added to total income of SSC. So this interest income will be added to total income of previous year 24-25. Clear everybody? Next 25-26. In previous year 25-26, he paid additional income tax, right? What is the range? 1st April 25 to 31st March 26. When he paid additional income tax on 30 June 25, he paid additional income tax, correct? So during this period, interest income will be added. For this period, no interest income because he has already paid additional income tax, right? Once he pays additional income tax, post that date, secondary adjustment provisions are not applicable and interest income will not be calculated. Are you able to understand? So for 25-26, you should not calculate interest income for 365 days. You have to calculate only for 3 months. April 30 days, May 31, June 30. You have to calculate interest income only for 91 days. Are you able to understand? So interest income for previous year 25-26. How much is excess money? 2.2 crores into interest rate. You have to take SBI marginal cost of lending rate as on 1st April 25. How much is SBI marginal cost of lending rate as on 1st April 25? 13%. Correct. 2.2 crores into 13% plus 3.25% into only 91 days, 3 months till 30th June. 91 by 365. How much? 220 into 1 lakh. 13 plus 3.25. 16.25. 8,91,301. Next, one time additional income tax also we need to calculate. One time additional income tax payment. How much? 20.9664%, right? So excess money into 20.9664%. How much is excess money? 2.2 crores into 20.9664 percentage. How much? 46 lakh 12,608. That is the one time additional income tax that is payable on 30th June. Okay. I hope you got clarity. Now you will do one thing. Pause the video right now. Go through entire concept once again for 5 minutes. Then listen remaining video. Okay. Next we will see reason 2. If primary adjustment is made by assessing officer and it is accepted by SSC. That means AO made primary adjustment. SSC, why to have headache with assessing officer? SSC accepted the primary adjustment. Whenever SSC accepts primary adjustment made by assessing officer, and if primary adjustment amount is more than 1 crore, SSC should bring back repatriate excess money to India within 90 days. And those 90 days are to be calculated from the date of assessment order, because we file ITR, assessing officer will do assessment after some time. We do not know. That's why the date on which assessing officer passed the assessment order, on that day we know what is the excess money added by assessing officer. So from the date order is passed, from that date onwards, within next 90 days, excess money is to be brought to India. Are you able to understand? So in this case, excess money to be brought to India within 90 days, and those 90 days are to be calculated from ITR, from date of assessment order. Okay, from date of assessment order. If you do not bring excess money within 90 days, interest income will be calculated. From which date interest income will be calculated? Interest income will also be calculated from first, like from date of assessment order. Okay, within 90 days you have to bring. If you default, from date of assessment order only interest income will be calculated. Otherwise, interest income will be calculated. Interest income will also be calculated from date of assessment order. You got clarity? Reason 3 I will explain. First, I will explain the concept. You will have some confusion. Wait, then I will explain one example. You will get complete clarity. So, I need your support. You have to listen carefully till the end. You will understand. Okay. So, reason 3, if primary adjustment is due to APPA, is due to advance pricing agreement APPA. Now, we have to check when advance pricing agreement is signed. Advance pricing agreement, if signed before ITR due date, one procedure is there. If signed after ITR due date, another procedure is there. If advance pricing agreement is signed before ITR due date, if advance pricing agreement is signed after ITR due date, I will explain with example. Have patience. If advance pricing agreement is signed before ITR due date, then excess money to be brought to be brought within 90 days from within 90 days from actual ITR filing date. Very important. Within 90 days from actual ITR filing date. Okay. If you do not bring excess money within 90 days from actual ITR filing date, then interest income will be calculated. Interest income will be calculated from which date? Else, interest income will be calculated from ITR due date. You have to observe carefully. 90 days are to be calculated from actual ITR filing date. Within those 90 days, you have to bring excess money. If you do not bring, interest income will be calculated not from actual ITR filing date. Interest income will be calculated from ITR due date. So from first day after ITR due date, interest income will be calculated. Now, I will explain example. You will get clarity. Listen carefully. Let's say Appa signed on 14th August 2026. When advance pricing agreement was signed, 14th August 2026. For previous year 25-26, what is corresponding assessment year? Assessment year 26-27. Correct. In 26-27, what is ITR due date? ITR due date is 30 November 2026. Okay. When ITR was actually filed, ITR actually filed on 10th December 26. That means ITR is filed after due date. But when APPA was signed before 30th November 26. APPA was signed on 14th August 26. That means APPA was signed before ITR due date. That means APPA was signed before 30th November 2026. In this case, how to handle? From 10th December 26, you have to calculate 90 days. That means in December 31 days are there. Take 10 days out. 21 days December. January 31 days. February 28 days, 80 days. March 10 days. So 90 days, 90th day is 10th March 2027. You have to bring excess money. Excess money. If you do not bring excess money, interest income will be calculated. Do you calculate interest income from this date? Interest income from this date? Answer is no. You will not calculate interest income from this date. You will calculate interest income from this date. Are you able to understand? So from first day after ITR due date, you are going to calculate interest income. Okay. I hope now you got clarity. If advance pricing agreement is signed before ITR due date, you have to repatriate excess money within 90 days from actual ITR filing date. If you do not repatriate, interest income will be calculated. Interest income will not be calculated from actual ITR filing date. Interest income will be reckoned from first day after the ITR due date. Are you able to understand? I hope you got clarity. If APPA is signed before ITR due date. Next I will explain APPA signed after ITR due date. If you have any confusion, listen once again, you will get clarity. Now, if APPA is signed after ITR due date, then what are the rules? Then excess money to be brought to India within 90 days from end of month in which APPA is entered, which advance pricing agreement is entered. Otherwise, else interest income will be calculated from end of month in which APPA is entered, from end of month in which advance pricing agreement is entered. Shall I give example for this so that you will understand better? Yes, I will mark this as A. Next one B. Let's say second example, APPA signed on 22nd December 2026. So for previous year 25-26, what is corresponding assessment year? Corresponding assessment year is assessment year 26-27. So what is ITR due date? ITR due date is 30 November 26. When APPA was signed on 22nd December 26. That means APPA was signed after ITR due date. So as APPA was signed after ITR due date, by that time you have already filed ITR. Now, as you have already filed ITR, as per advance pricing agreement, again you will calculate arm's length price. And if there is any primary adjustment, that primary adjustment as per advance pricing agreement is to be brought to India within 90 days from end of the month in which APPA is entered. That means APPA is entered in December. What is end of month? End of month is 31st December 2026. From here onwards, you need to calculate 3 months. That means 31st March 27, correct? On or before 31st March, not 3 months, what is it? 90 days, right? I'm sorry. Within 90 days from end of the month in which APPA is entered. So 90 days, January 31, February 28, March 31. So yeah, again it is March 31st only, 31st March 27. So on or before 31st March 27, excess money is to be brought to India. Otherwise, interest income will be calculated from end of the month. That means technically from 1st January 27 onwards, interest income will be calculated if you do not bring excess money on or before 31st March 2027. Are you able to understand? Reason 3 is a bit complicated. If you understand well and good, if you have any little bit of confusion, you listen to this lecture one more time. Okay, only reason 3, listen once again, you will get complete clarity. Okay. Out of 5 reasons, only these 3 reasons are very much important and are being asked in the examination. Reason 4, reason 5, I'll teach you, but they are not that important from exam point of view. You can skip them also, but as a token of class, I will explain reason 4 and 5 as well. Reason 4, if primary adjustment is due to safe harbor rules. Adjustment is due to safe harbor rules. What do you mean by safe harbor rules? I will teach at the end. But safe harbor rules means government will already give predetermined percentages. Let's say you are into research and development. Government said if you are providing research and development services, your operating profit margin is 15%. If you maintain 15% margin, again esting officer will not calculate arm's length price. Department will accept your transaction price. But if your operating profit margin is only 13%, then whatever difference 2% is there, that will be treated as primary adjustment. Are you able to understand? So safe harbor rules means government will give list of criteria for your industry. If you maintain your profit margins, your transfer prices as per that list, as per safe harbor rules, then whatever your actual price is there, that will be accepted as arm's length price. Otherwise, whatever the difference between your price and safe harbor price is there, that difference will be treated as primary adjustment. And if primary adjustment is more than 1 crore, secondary adjustment provisions are also applicable. You have to bring excess money to India within 90 days. Those 90 days are to be calculated from which date I will teach now. Okay. So here in this case, excess money to be brought to India within 90 days from ITR due date under section 139 subsection 1. From ITR due date under section 139 subsection 1. Otherwise, interest income will be calculated. Else, interest income will also be calculated from ITR due date under section 139 subsection 1. Okay, clear? Super. Next, reason 5. If primary adjustment is due to is due to mutual agreement procedure, MAP, mutual agreement procedure, MAP. See, primary adjustment is due to MAP. Sir, what do you mean by mutual agreement procedure? There is one chapter called DTAA, Double Taxation Avoidance Agreement. India will enter into double taxation avoidance agreement with other countries. If at all any matter is not covered in DTAA, for those matters which are not covered in DTAA, our country will enter into mutual agreement procedure with other countries. Okay, because of mutual agreement procedure, if primary adjustment is done, then secondary adjustment is to be calculated from which date? Excess money is to be brought to India within 90 days from which date? That we are going to see. In this case, excess money to be brought to India within 90 days from date of giving effect to, from date of giving effect by fixing officer to mutual agreement procedure. That means the date on which ever gives effect to mutual agreement procedure, from that date onwards within next 90 days excess money is to be brought to India. Otherwise else interest income will be calculated. Interest income will be calculated from, interest income will also be calculated from date of giving effect by assessing officer to mutual agreement procedure. Are you able to understand? So these are the 5 reasons where you have to do secondary adjustment. Out of these 5, first 3 are very important. Go through them sufficient. So previously we have discussed the secondary adjustment. Now we are going to discuss section 94B. A bit important from exam point of view, can be asked in the exam. Limitation of interest benefit. Yes. So I'll take one example and then I'm going to explain you very clearly. First of all, there is a Meta Inc. USA and there is Meta India Limited. Meta India Limited is subsidiary company of Meta Inc. USA. Now, Meta India Limited need funds. Who will give funds? Obviously, parent company is going to give the funds. To give funds, parent company has two options. Either funding can be given in the form of debt or in the form of equity. Correct? If funding is given in the form of equity, how return will be paid? Return will be paid in the form of dividend. But whether dividend is allowed as deduction, dividend is not allowed as expenditure. If dividend is not allowed as expenditure, is it beneficial to Indian company? It is not beneficial to Indian company. But if Indian company, being subsidiary company of foreign company, borrows funds in the form of debt, then how return will be paid? Return will be paid in the form of interest expenditure. Correct? Whatever interest paid, that is allowed as deduction. Interest paid is allowed as deduction. So what many Indian companies are doing, they are borrowing money from associated enterprises, and whatever the money borrowed from associated enterprises is there, on that borrowed money, they are paying interest. Intentionally, they are paying higher rate of interest so that they can claim extra interest expenditure. So to counter such kind of activities by Indian companies, to stop them from paying extra interest, the government came up with one concept called Section 94B. What Section 94B says? whatever interest you pay to your associated enterprise. Whenever you take loan from associated enterprise, you are going to pay interest, right? Total interest is not allowed as expenditure. Maximum interest allowed as deduction is up to 30% of EBI TDA. You know EBI TDA, right? In CA Inter Financial Management Ratio Analysis chapter, you have done many problems using EBI TDA, earnings before interest, tax, depreciation, and amortization. You remember? Yes. So the thing is, whenever uh, Indian enterprise borrows funds from associated enterprise located outside India, whatever the interest paid by Indian company is there, total interest is not allowed as deduction. Total interest or maximum up to 30% of EBI TDA, whichever is lower will be allowed as deduction. So what is the rule? Rule is interest paid to associated enterprise cannot be more than 30% of EBI TDA. So we can simply write one formula. Max interest allowed. Max interest paid to associated enterprise allowed as deduction is equal to actual interest paid or 30% of EBI TDA, whichever is lower will be allowed as deduction. Are you able to understand? That is the maximum interest which is allowed as deduction. Now I will take one more example. I will discuss another case with you. Let's say there is Tesla Inc. based in USA. Let's say there is Tesla India Limited. Of course, Tesla India Limited is wholly owned subsidiary of Tesla Inc. If in that case, both are treated as associated enterprises, correct? Now, what happened? Indian company borrowed 100 crores from associated enterprise. Interest rate is 12%. Next, EBI TDA is 30 crores. Now, shall we do the math? Shall we solve? How much is the maximum interest allowed as deduction? Max interest allowed as deduction is equal to actual interest or 30% of EBI TDA, whichever is lower. How much is actual interest? Actual interest is 100 crores into 12%, 12 crores, or 30% of EBI TDA. That means 30 crores into 30%, 9 crores. Whichever is lower means how much, only 9 crores allowed as. Now, the thing is, how much is total interest? Total interest paid to associated enterprises 12 crores. Out of 12 crores, how much is allowed, how much is disallowed? 9 crores allowed. Remaining 3 crores is disallowed, right? But this is not disallowed forever. Whatever 3 crores disallowed is there, this can be carried forward and set off in subsequent 15 years. Sorry, in subsequent 8 years. MAT credit, AMT credit 15 years. But here, whatever in section 94B, whatever the interest that is disallowed in current year is there, that can be carried forwarded and that can be set off in subsequent 8 years within 30% limit. Okay. Within 30% EBI TDA limit. That means in subsequent years also, we will calculate 30% of EBI TDA limit. Within that limit only, this 3 crores is eligible for set off. For example, same case in 26-27, EBI TDA of Tesla India Limited is Tesla India Private Limited is 46 crores. Now, how much is interest allowed as deduction? Max interest allowed as deduction is equal to, you know the formula, actual interest or 30% of EBI TDA, whichever is lower, correct? How much is actual interest? Actual interest is 12 crores. We have done 100 crores into 12%. 12 crores is the actual interest, correct? So 12 crores or 30% of EBI TDA. How much is EBI TDA? 46 crores. 46 crores into 30%, whichever is lower. So 46 into 30%, how much? 13.8 crores. So 12 crores or 13.8 crores, whichever is lower. Obviously, actual interest is 12 crores, right? So 12 crores. That means, therefore, total 12 crores is allowed as deduction. But the thing is, in 26-27, how much is EBI TDA? In previous year 26-27, 30% of EBI TDA. How much? 30% of EBI TDA is equal to, in 26-27, how much? 13.8 crores. Out of 13.8 crores, 12 crores of 26-27 can be claimed, and how much amount is eligible for set off with brought forward credit? 13.8 crores minus 12 crores. How much? 1.8 crores. 1.8 crores you can use to set off with brought forward credit, right? How much is brought forward credit? Brought forward credit is 1.8 crores. Am I correct? Sorry, brought forward credit is 3 crores. So from 25-26, how much was brought forwarded? 3 crores. But can you set off 3 crores? No. Total 1.8 crores you can set off, less brought forward credit of 25-26. 1.8 crore you can set off. Okay. So how much is brought forward credit of 25-26? Brought forward credit of 25-26 is 3 crores. Out of 3 crores, how much you set off? 1.8 crore set off in previous year 26-27. Balance how much is there? 1.2 crores. This will be carry forwarded to subsequent 7 assessment years. Are you able to understand? Because this is not belonging to 26-27, that is belonging to 25-26. So whatever 1.2 crores is there, that already in 26-27 you have utilized, and out of 3 crores you have already set off 1.8 crores. Balance whatever 1.2 crores is there, that is eligible for set off for subsequent 7 assessment years. Next, I will take one more example and conclude this concept. There is Nike Inc. and there is Nike Limited India. Both are associated enterprises. That means Nike Inc. have stake in Nike India Limited, so both are treated as associated enterprises. So if loan is taken directly, section 94B applies, correct? So what Nike Limited will do? Nike Limited will not take loan directly from Nike Inc. It will not take like this. What will happen? Nike Inc. it is US based company. Nike Inc. will go to Bank of America. What Nike Inc. will give? It will deposit 100 crores. Okay. Or it will give guarantee for 100 crores. Based on deposit of 100 crores by Nike Inc. or based on guarantee given by Nike Inc., what Bank of America is doing? Bank of America gave loan of 160 crores to Nike Limited India. Are you able to understand? That means what? We are like Nike India Limited. Indian company is not directly taking loan from associated enterprise. Indian company is taking loan from a bank outside India. However, our associated enterprise deposited money with other bank. Our associated enterprise gave guarantee to other bank. From that bank, Indian company is taking loan. That means they are playing game, right? If they take loan directly, section 94B becomes applicable. So they are not taking loan directly, they are taking loan indirectly. In this case, to the extent of matching amount, how much is matching amount? Matching amount is 100 crores. Okay. So whatever the matching amount is there, to the extent of matching amount 100 crores, section 94B is applicable. Even though loan is given by Bank of America, it will be deemed as, to the extent of matching amount, it will be deemed as loan given by associated enterprise, and section 94B is applicable. Okay, section 94B is applicable. Are you able to understand? So this is how it works. Even the loan is given by third party, but our associated enterprise deposited money with third party, or our associated enterprise gave guarantee to third party. Even the loan is given by third party, still it will be deemed as loan given by associated enterprise to the extent of matching amount, and section 94B is applicable. Are you able to understand? Clear? Next. One more point. Again, if only if interest paid to associated enterprise is more than 1 crore, then only section 94B is applicable, just like secondary adjustment. Okay, secondary adjustment is applicable only if primary adjustment is more than 1 crore. Here also, section 94B is applicable only if interest paid to associated enterprise is more than 1 crore in a financial year, then only section 94B is applicable. So, section 94B is applicable if interest paid to. However, here there is one loophole, not aggregation. Let's say Indian company is there. It has 4 subsidiary companies, 4 associated enterprises. Now 1 crore limit, is it applicable for each associated enterprise or for aggregation of all associated enterprises? Answer is each associated enterprise. If interest paid to each associated enterprise is more than 1 crore in a previous year, is more than 1 crore in a previous year, then only section 94B is applicable. Otherwise section 94B is not applicable. Are you able to understand? So you can use it as a loophole. Instead of taking lump sum amount from your associated enterprise, you can do tax planning. Another important point, section 94B does not apply to banking companies, insurance companies, finance companies in IFSC, notified NBFCs. So, whenever banking companies, insurance companies take loan from their associated enterprises, section 94B is not applicable. Next, interest paid to Indian PE of a non-resident bank engaged in banking business. That means, let's say HSBC is there. It is Chinese-based bank, Hong Kong and Shanghai business company. It has subsidiary company in India. So, like if Indian company pays interest to parent company, then also 94B provisions are not applicable. Simple banking and insurance companies and those finance companies engaged in IFSC, notified NBFCs, for these entities, section 94B provisions are not applicable. Now we will see penalties under transfer pricing. Sometimes an MCQ might be asked uh, from this concept. That's why I'm revising. Section 270A fails to report any transactions would constitute misreporting of income. See, there is a concept under reporting of income or misreporting of income. That means what? If there is difference between Return income, income that is disclosed in ITR, and subsequently if assessing officer finds any new income. Okay, so whatever the difference between assessed income and return income is there, that means assessing officer increased your income, and you have the reason for increase of income is you have intentionally avoided the expenditure, or you have intentionally reduced the sales, reduced the income. That means with a willful attempt, with an intentional attempt, if you reduce your income and later on income is increased by assessing officer, that is called as misreporting of income. Not only transfer pricing, any under income tax act, under any provision, if there is misreporting of income, then department will levy 200% of tax payable. That means on that misreporting of income, whatever the tax liability is there, you need to pay the tax, and 200% of the tax you have to pay as penalty. Let's say intentionally I have not disclosed 50 lakhs of income. On 50 lakhs, tax liability is 20 lakh rupees. I have to pay 20 lakhs, and I also have to pay 40 lakhs as penalty. Are you able to understand? So with a willful attempt to evade payment of tax, if you intentionally decrease your income either by way of writing bogus expenditure or reducing your sales, reducing your income, then whatever the under reporting of income is there, that will be classified as misreporting. If you do not do intentionally, it will be treated as under reporting of income. Even for under reporting of income, there is penalty. Penalty is 50% of tax liability. But with a willful attempt, if you avoid payment of tax, that is misreporting of income, for that penalty is 200% of tax liability. Are you able to understand? Next, failure to keep and maintain information or documents. I have discussed in earlier classes also, you need to maintain the information. What is the basis for calculation of arm's length price? Which method you have followed? What is the base data? All these documentation, books and records you have to maintain. If you fail to maintain, how much is the penalty? 2% of value of international transaction. That means what? Whatever the transactions that for which you have not maintained records, that transaction value into 2%, that amount you have to pay as penalty. Okay, next, failure to report a transaction, failure to maintain, furnish correct information or documents. Whenever a department asks, you should produce information. If you fail to produce information like transaction value into 2%, you are liable to pay as penalty. Next, failure to furnish information and documents required under section 92D. See, country by country reporting. What do you mean by this? Whatever Infosys is there, it is headquartered in India, but it has branches across some 20-30 countries. Now Infosys India has to submit international country by country reporting. In each country, what is the revenue made, what are the taxes paid. So all this information Infosys has to submit to Indian Income Tax Department. If it fails to submit, penalty is 5 lakh rupees. Are you able to understand? Next, failure to furnish information required during the proceedings under section 92D3. That means what? Whenever proceedings are going on, whenever department asks the information during the course of proceedings means what? Assessing officer doing assessment, or transfer pricing officer calculating arm's length price. Whenever department asks information from you during the proceedings, you have to provide the information. If you fail to provide the information, penalty is 2% of transaction value. Next, I already told you, whenever transfer pricing provisions are applicable, you are required to get your books of accounts audited by a chartered accountant. If you fail to get your books of accounts audited, penalty is 1 lakh rupees. Other than transfer pricing, I am a regular business person. I do not do international transactions. If I do not get my books of accounts audited, penalty is 0.5% of turnover or 1,50,000, whichever is lower. That is, if you do not get audit in non-transfer pricing cases. In transfer pricing, if you fail to get your books of accounts audited, penalty is 1 lakh rupees. So, transfer pricing, no audit done, penalty 1 lakh. Non-transfer pricing cases, no audit done, penalty is 0.5% of turnover or 1,50,000, whichever is lower. Okay, next. Section 92E, audit report. Generally, ITR due date in case of tax audits, like if anyone is required to get tax audit, then ITR due date is 31st October. ITR due date 31st October. Okay, but whenever transfer pricing provisions are applicable, then ITR due date is 30th November of assessment year. 30th November of. This is due date for filing ITR. In this case, tax audit due date is 1 month prior to ITR due date. So tax audit due date here is 31st October of assessment year. Are you able to understand? So whenever transfer pricing provisions are applicable, you have to file income tax return on or before 30th November of assessment year. And you have to submit report of a chartered accountant. What is the due date for submitting report of a chartered accountant? Due date is 31st October. Are you able to understand? On or before 31st October of assessment year, you have to submit the audit report. Clear? So due date is 31st October of assessment year. Next we will discuss section 94A, notified jurisdictional area. See, earlier there is one country, Cyprus. Cyprus is the country which do not support to India. Whenever Indian government asks some information from Cyprus country will not give that information. So it has become a loophole. Many people, Indians, they are depositing money in banks in Cyprus because Cyprus will not give information to Indian tax department, Indian government. That has become a loophole. So there are some countries which do not cooperate with Indian government. Indian government will declare those countries, those areas as notified jurisdictional areas. Any company, any person in India, if they do transaction with a person located in notified jurisdictional area, that person will be deemed as associated enterprise. That transaction will be deemed as international transaction, and transfer price for the transaction will be calculated at arm's length price. Very simple. There are some countries which do not cooperate with India. Those countries will be declared as notified jurisdictional area. Any person in India, if we do transaction with a person located in notified jurisdictional area, irrespective of their relation, they will be deemed as associated enterprises. Their transaction will be deemed as international transaction. And every transaction that is done with a person located in notified jurisdictional area, the transaction will be calculated at arm's length price. Are you able to understand? So that is the provision. Another point, I have told you one concept, range concept, and if more than one arm's length price is available and up to 5 arm's length prices, you can take average arm's length price. Average arm's length price will be taken as final arm's length price. And straight away average arm's length price is not final arm's length price. You have to, what you have to do, you have to find the difference. If difference between average arm's length price and actual price is up to 3%, then actual price will be taken as final arm's length price. If difference between average arm's length price and actual price is more than 3%, then average arm's length price will be taken as final arm's length price. So 3% tolerance bend is available, right? That 3% tolerance bend is also not available whenever you do transaction with a person located in notified jurisdictional area. Very simple. 3% tolerance bend, that benefit, 3% benefit is not available whenever you do transaction with a person located in notified jurisdictional area. Are you able to understand? That means what? Whenever you do a transaction with person located in NJA, notified jurisdictional area, and if more than one arm's length prices are available, up to 5 arm's length prices are available, you will calculate average arm's length price. Whatever average arm's length price is there, that will be taken as final arm's length price. 3% tolerance bend benefit is not available. Are you able to understand? So whenever transaction is done with a person located in notified jurisdictional area, it will be deemed as associated enterprise. That person, that transaction will be deemed as international transaction, and all transfer pricing provision shall apply. 3% tolerance bend, that benefit is no longer available. Now, case transferred to transfer pricing officer. See, there will be assessing officer. While doing assessment, he has some doubt. He wants arm's length price to be calculated. But assessing officer is not expert in calculation of arm's length price. Small things, small transactions, assessing officer can calculate arm's length price. But the transaction is very complicated. Assessing officer could not calculate arm's length price. Then assessing officer, while doing the assessment, if he wants to refer, he can refer the case to transfer pricing officer. Okay. But before referring, he need to take prior approval of CIT or PCIT, Commissioner of Income Tax, or Principal Commissioner of Income Tax, CIT or PCIT. For example, AO referred 5 international transactions to transfer pricing officer. But SSC have done 9 international transactions. Can transfer pricing officer consider 9 international transactions? Can he calculate arm's length price for 9 international transactions? Answer is yes. SSC have done. SSC have done 9 international transactions. For these 9 international transactions, arm's length price can be calculated by transfer pricing. So once reference is made to transfer pricing officer, he can utilize all the data that is available with him. He can obtain additional data from SSC also, and transfer pricing officer can calculate arm's length price either for transactions referred by assessing officer or for all transactions done by SSC. Are you able to understand? Next, whatever the TPO order is there, transfer pricing officer TPO order is binding on assessing officer. That means whatever order passed by transfer pricing officer is there, that order should be considered by assessing officer in his assessment. Assessing officer cannot ignore the order passed by transfer pricing officer. Assessing officer should consider order passed by TPO. So TPO is superior. Order passed by transfer pricing officer is binding on the assessing officer. Are you able to understand? Next, under Income Tax Act, for any kind of assessment, whatever the time limit available to assessing officer is there, that time limit will be further extended by 12 months whenever case is referred to transfer pricing officer. Are you able to understand? For example, previous year 25-26 is there. What is corresponding assessment year? Corresponding assessment year is 26-27. With regard to 26-27, notice was issued. Due date for issuing scrutiny assessment notice 143.2 is 30th June of financial year following the assessment year. So 30th June 2027. So 143.2 notice was given. Whenever 143.2 notice is given, obviously assessment will be done. What is the due date for completion of assessment? Due date for completion of assessment is 31st March 28. Due date for completion of scrutiny assessment. Correct. Now, yes. For example, in this case, in 143.2, if case is referred to transfer pricing officer, then due date is not 31st March 2028. AO will get extra 1 year time limit. Are you able to understand? 12 months. So extra time limit 31st March 2029. That is time limit for completion of scrutiny assessment. So this will be the due date for completion of scrutiny assessment if case is referred to transfer pricing officer. Now, next, sir, assessing officer will get extra 1 year time limit. What is the time within which transfer pricing officer should give transfer pricing? Transfer pricing order. After calculating arm's length price, TPO will issue transfer pricing order. What is the due date? At least 60 days before the due date for completion of assessment. What is due date for completion of assessment? 31st March 29. 60 days before. 60 days before means what is the date? 30 January 29. On or before 30 January 2029, TPO has to pass the order. Transfer pricing officer has to pass the. Are you able to understand? So these are the deadlines, due dates. Generally, whatever the time limit available for assessing officer, that will be extended by extra 1 year if case is referred to transfer pricing officer. TPO has to give the transfer pricing report at least 60 days before the completion of due date for completion of assessment. Okay, next. Recently, in Finance Act 2025, there is this concept called block transfer pricing assessment. What do you mean by block transfer pricing assessment? See, for 1 year, transfer pricing officer calculated arm's length price. Next year also case will go to transfer pricing officer. Again transfer pricing officer will calculate arm's length price. So big companies are there. Every year transfer pricing officer is calculating arm's length price. It is irritating to SSC. It is burdensome to department also. So the government came up with one concept called block transfer pricing assessment. What do you mean by this? For example, I'm a very big company. I will do international transactions. I will apply for block transfer pricing assessment. If I apply for block transfer pricing assessment, transfer pricing officer will calculate arm's length price. Okay. After transfer pricing officer calculates arm's length price for 1 year, for next 2 years, the same arm's length price will apply. For next 2 years, again transfer pricing officer will not calculate arm's length price. Are you able to understand? So happy if department comes, if transfer pricing officer calculates arm's length price for 1 year, happy. For next 2 years, he will not touch us. He will not come to our office. Are you able to understand? So applying 1 year's arm's length price for the next 2 years, that concept we call as block transfer pricing assessment. So ALP determined for international transaction for one previous year can be applied to similar international transactions for the next 2 consecutive previous years. But SSC has to exercise the option of applying same arm's length price to next 2 years. See, anything should be done from SSC point of view. I have to choose. Okay, I have to apply for block assessment. Then income tax department will apply 1 year's arm's length price for next 2 years. Are you able to understand? TPO shall within 1 month from end of the month in which option is exercised pass a written order declaring option is valid. But this block transfer pricing assessment does not apply to search cases. What do you mean by this? Current year applied for block transfer pricing assessment. Current year transfer pricing officer came to our office. He calculated arm's length price. Next year there is raid in my office, and because of that raid assessment is happening. Now transfer pricing officer came. I cannot object him. I cannot ask for block transfer pricing assessment. Next year as raid is conducted, block transfer pricing assessment will not apply. Next year, tra- uh, next year transfer pricing officer can calculate again arm's length price. So generally, if TPO calculates arm's length price for 1 year, for next 2 years, he will not come to our office. But in next 2 years, if raid happens, block transfer pricing assessment provisions will not apply. Whenever raid happens, TPO has power to calculate arm's length price and he will consider it in assessment. Are you able to understand? Good. Now we will discuss safe harbor rules. Till now, no question is being asked, but in RTPs, some questions are being asked from safe harbor rules. So that's why I'm revising even safe harbor rules also for your safety. Worst case, if I say gives paper a bit difficult, then you should be able to handle it. That's why I will discuss safe harbor rules also. Sir, what do you mean by safe harbor rules? Basically, income tax department itself will tell some margins. Whenever you do transaction with your associated enterprise, if you maintain that margin, then whatever your actual price is there, actual price will be accepted as arm's length price. Again, department will not calculate arm's length price. Again, department will not do transfer pricing audit. Are you able to understand? For example, you go to next page. Here, software development services of operating profit margin by operating cost 17%. So whenever you are providing software services to your associated enterprise, what is safe harbor margin? 17%. If you minimum maintain 17% operating margin, then whatever your actual transaction price is there, that itself will be deemed as arm's length price. Again, transfer pricing officer will not calculate arm's length price. Transfer pricing officer will not do audit. He will not do assessment. Are you able to understand? So, safe harbor rules, when they are applicable, first SSC has to apply for safe harbor rules. Only when SSC applies, then only safe harbor rules are applicable. For how many years safe harbor rules are applicable? In the application, you can mention years. I can mention 1 year, 2 year, 3 year, 4 year. No, maximum safe harbor rules are applicable for 3 years. In safe harbor rules application, I applied for 5 years. Will they apply for 5 years? 5 years or maximum 3 years. That means whichever is lower, they are applicable for 3 years. So safe harbor rules are applicable for any number of years, but maximum you can apply for 3 years. Okay. So years applied in the application or 3 years, whichever is lower. Next, once the safe harbor rules are made applicable to you, If you maintain safe harbor margins, then whatever your actual price is there, that will be deemed as arm's length price. If you do not maintain safe harbor margin, then department will come and do calculation of arm's length price, and department will do transfer pricing audit. You have to maintain documentation. But if you maintain safe harbor margins, you are not required to maintain documentation, and department will not do calculation of arm's length price. Department will not do any assessment. Okay. And in which form you will apply? You will apply in form 3CE FA, and you can apply maximum for 3 years. Sir, I applied for safe harbor margin. Next year I want to withdraw. Can I withdraw from safe harbor rules? Answer is yes. You can opt out any time from safe harbor rules by giving written declaration to assessing officer. Are you able to understand? Next, if safe harbor rules are applicable, then like you have to maintain transfer pricing documentation and obtain accountant's report. What do you mean by this? Even though safe harbor rules are applicable, still you are required to get your books of accounts audited by a chartered accountant. No exemption from getting books of accounts audited. Even though safe harbor rules are applicable to you, still you are required to get your books of accounts audited by a chartered accountant, and you have to file ITR on or before 30th November. And I'm sorry, one more thing, you have to maintain transfer pricing documentation also. So even though safe harbor rules are applicable, like department will not do assessment, department will not do calculation of arm's length price, but still you have to maintain transfer pricing documentation. Still, like whatever the base data used in calculation of arm's length price, whatever your required documents are there, all of them you have to maintain, and you have to maintain safe harbor margin. Then whatever your actual price is there, that will be accepted as arm's length price. So simple, crisply, even though safe harbor rules are applicable to you, still you have to maintain documentation. You have to get your books of accounts audited by a chartered accountant. Next, if associated enterprise is located in low tax jurisdiction, what do you mean by low tax jurisdiction? Tax is less than 15%. For example, Dubai. In Dubai, there is no income tax. Whenever you do transaction with a party located in Dubai, safe harbor rules are not applicable. That means whenever you do transaction with any party located outside India, in that jurisdiction, if tax rate is 15% or lower than 15%, safe harbor rules are not applicable. So safe harbor rules are applicable only if tax rate of your associated enterprise is more than 15%. Are you able to understand? So if you do transaction with any party located outside India, and in that tax jurisdiction, if tax rate is less than 15%, safe harbor rules are not applicable. Are you able to understand? Next, safe harbor rules and mutual agreement procedure. I told you in secondary adjustment, sometimes Indian government along with foreign government, they will enter into mutual agreement procedure. For the matters that are not covered under DDAA, they will separately enter into mutual agreement procedure. So if safe harbor rules are applicable, mutual agreement procedure is not applicable. If safe harbor rules are not applicable, mutual agreement procedures are applicable. So mutually exclusive means what? That's what. If one is applicable, second is not applicable. If one is not applicable and second is applicable. Okay. Now, shall we see safe harbor margins? So first, software development services. Whenever software development services are provided to associated enterprise, how much margin you have to maintain? If aggregate international transaction is less than or equal to 100 crores, then you have to maintain 17% operating profit margin. If amount of transactions, international transactions are more than 100 crores but less than or equal to 300 crores, then you need to maintain minimum 18% operating profit margin. Now students will get doubt, sir, what if value of international transactions are more than 300 crores? Then safe harbor rules are not applicable. As per regular provisions, transfer pricing officer come, he will calculate the arm's length price. Are you able to understand? So generally, whenever Indian company is providing software development services to associated enterprise, you have to remember two percentages, 17%, 18%. If transaction value less than 100 crores, 17% margin is required to be maintained. If transaction value is more than 100 crores and up to 300 crores, 18% margin is required to be maintained. Next, IT enabled services, BPO services, business process outsourcing. You know BPOs, right? In Hyderabad, most of the companies, whatever the work they are doing, that is BPO work only. Okay. So if BPO services are provided to an entity located outside India, then also same copy paste. If amount of international transactions are up to 100 crores, you need to maintain 17% operating profit margin. If international transaction greater than 100 crore but less than or equal to 300 crore, you need to maintain 18% operating profit margin. So remember, software services, BPO services, international transaction value less than 100 crores, minimum margin 17%, international transaction value more than 100 crores up to 300 crores, margin is 18%. Are you able to understand? Clear everybody? Next, knowledge process outsourcing services, high-end analytics and design, etc., where value of international transaction is less than or equal to 200 crores. See, maximum a question will not be asked from safe harbor rules. If at all question is asked, I predict question can be asked from software services and IT enabled BPO services. So remember these two margins very carefully. Of course, it's very tough to retain all these margins till the time of the exams, but at least first two, 17%, 18%, please keep in your mind. Okay. So here, employee cost as a percentage of operating expenditure. If employee cost percentage is less than 40%, minimum operating profit margin is 18%. If employee cost percentage is greater than 40% but less than 60%, minimum you have to maintain 21% operating profit margin. If employee cost is greater than 60%, then you have to maintain 24% operating margin. If you maintain that margin, whatever your actual price is there, that will be deemed as arm's length price. Are you able to understand? So I'll take one more example. For example, let's say total cost of expenses 460 crores. Let's say employee cost is 340 crores. Now, how much is percentage of employee cost? 340 by 460 into 100. How much? 73.9%. That means employee cost percentage is more than 60%. You have to minimum maintain. So whenever you provide knowledge process outsourcing services to your associated enterprise and percentage of employee cost is more than 60% on whatever the transaction value is there, on that minimum you have to add 24% operating margin. Then whatever your actual price is there, that will be deemed as arm's length price. Are you able to understand? Clear everybody? So this is not that important. Still you can remember 18, 21, 24. Up to 40, 40 to 60, above 60. So you have to remember two things. 40 to 60 margin, 18, 21, 24. Knowledge process outsourcing. Below 40, 18%. 40 to 60, 21%. Above 60, 24%. Are you able to understand? Clear everybody? Confirm. Now, intra-group loan denominated in Indian rupees. That means one company in India is giving loan to non-resident associated enterprise. We have already discussed whatever the interest income is there, that is also treated as transaction. So for that transaction also transfer pricing provisions are applicable. So whenever one company in India is giving loan to another company and if the amount of loan is denominated in Indian rupees, okay, then what is the interest rate? Minimum acceptable interest rate is SBI 1 year marginal cost of lending rate as on 1st April of previous year plus additional spread. Are you getting anything in your mind when you hear these words? Yeah, we have already discussed in secondary adjustment. They need to bring back excess money to India. Otherwise, interest income will be calculated. If transaction is denominated in Indian currency, SBI 1 year marginal cost of lending rate as on 1st April of previous year plus 3.25%. If transaction is denominated in foreign currency, 6 months LIBOR plus 3%. You remember here also when Indian company gives loan to another associated enterprise and if transaction is denominated in Indian currency, minimum acceptable interest rate. So how much is the minimum interest rate it should charge? SBI 1 year marginal cost of lending rate as on 1st April of previous year plus additional spread. Additional spread is decided based on credit rating. If credit rating of associated enterprise is triple A to A, you have to add additional spread 1.75%. If credit rating is triple B minus triple B plus, that means if credit rating decreases, interest rate increases. Because if credit rate decreases, risk increases. Whenever risk increases, interest rate also increases. Are you able to understand? So if credit rating is in between BB to B interest rate, you need to add additional spread 4.75%. If credit rating is in between C to D, you need to add additional spread 6.25%. If there is no credit rating and if amount of loan is less than or equal to 100 crore, you need to add 4.25% additional spread. I don't think so he will ask at this much depth. If he really asks at this much depth, paper will be at another level. Okay, at least small things you try to remember: software, BPO, knowledge process outsourcing. These though, how much ever I explain, it's very typical and difficult for you to remember. Next, intra group loan less than or equal to 250 crores. And if transaction is denominated in foreign currency, here transaction is denominated in INR, here loan amount is denominated in foreign currency, then how much is minimum acceptable interest rate? Minimum acceptable interest rate is equal to reference rate for that foreign company as on 30th September of previous year. Very simple. Every company will have central bank. In India, central bank is RBI. So every company has it. Sorry, every country. Every country has it's a central bank. In India, central bank is RBI. In other countries, some other banks, central banks will be there. Whatever the 6 months LIBOR, it is per UK, London Interbank Offered Rate. So in that country, whatever the central bank is there, 6 months, whatever the reference rate is there, you have to take that reference rate. To that reference rate, you need to add additional spread. If you minimum charge that much interest rate, then whatever your interest rate is there, that is acceptable. That is at arm's length price. Otherwise, department is going to calculate the arm's length price. Are you able to understand? So, how much is minimum acceptable interest rate? Reference rate plus if credit rating is triple A to A minus, you have to add 1.5% spread. If credit rating is decreasing, triple B minus, triple B B plus, then you have to add 3%. If there is no rating or lower rating, you have to add additional spread 4%. Next, intra-group loan more than 250 crores denominated in foreign currency. Then also reference rate plus additional spread. How much is additional spread? If credit rating is triple A to A minus plus 1.5%, credit rating triple B minus triple B plus, you have to add 3%. Credit rating BB plus to BB minus, you have to add 4.5%. If there is no credit rating, you have to add 6%. Are you able to understand? So, whatever this fourth and fifth are there, you try to remember. I don't think so. I say will ask at that much depth. Now, corporate guarantee. That means if one company gives corporate guarantee to non-resident associated enterprise, non-resident associated enterprise must be wholly owned subsidiary. Then only safe harbor rules are applicable. That means if Indian company gives loan to wholly owned subsidiary outside India, then not loan, whatever the loan taken by wholly owned subsidiary, for that loan, corporate guarantee is given by Indian company. Generally, whenever guarantee is given, fees will be charged. How much is the minimum fees that is required to be charged? Minimum 1% of the guarantee amount. Whatever the amount of loan for which Indian company is giving guarantee, out of that amount, at least 1% fee should be taken. If 1% fees is taken, that fees will be treated as arm's length price. If you charge fees less than 1%, then department will come and do calculation of arm's length price. Safe harbor rules are not applicable. This is also easy to remember. Corporate guarantee, safe harbor is 1% of guarantee amount. Next, research and development services relating to software development. See, here exclusively software development. Here what is being done is R&D services. That means what you are doing, you are not giving software services. You are doing R&D services, research and development services. But in which area you are doing R&D? R&D is being done in software development. So in software development, you are providing research and development services. Then if value of international transactions are less than or equal to 300 crores, minimum you should maintain 24% margin. Next, contract R&D services relating to generic pharma. That means with regard to pharma companies, if you do any R&D services located in India, that means for non-resident associated enterprise, you are providing R&D services sitting in India. Then if value of international transactions are less than or equal to 300 crores, minimum you should maintain 24% operating margin. Are you able to understand? Next, manufacture and export of core auto components. So what you are doing, let's say Royal Enfield is there. It is Indian brand. Royal Enfield is also having sales across various countries. Now, parent company is Royal Enfield India. It is what it is doing. It is supplying core automobile components. Core automobile components means what? Royal Enfield is exporting Royal Enfield engines to various countries. Engine is core component. Without engine, bike will not go. Okay. So seat is there. Seat is irrelevant. Without seat also bike will go. Seat is non-core component. But core component means what? Component without which that particular vehicle motor will not run. Motor vehicle will not run. So Indian company, it is exporting core auto components and original equipment sales are greater than or equal to 90% of total turnover. Then minimum margin required to be maintained is 12%. Sir, what do you mean by original equipment? One, one, one fine day, what happened? My car met with one accident. I sent my car to the showroom. After car went to the showroom, he replaced all the parts. I claimed insurance. Now, whatever the parts that are replaced are there, replaced parts are not original parts. Even Honda company has done replacement. That means what Honda is doing, Honda is selling cars. Whenever car comes for service, whenever car meets with an accident, it is also replacing parts. But whatever the original sales, that means actual sales, original equipment sales of Honda should be greater than or equal to 90% of total turnover. Then only safe harbor rules are applicable. So whenever Indian company exports core automobile components, out of total turnover of Indian company, minimum 90% of turnover should be original equipment sales. Then if you maintain 12% margin for those core automobile components exports, then your price will be taken as arm's length price. Are you able to understand? Safe harbor rules are applicable. And if you export non-core automobile components, minimum you have to maintain 8.5% margin. Are you able to understand? Next. The students are asking me to repeat ninth point. Basically, in a motor vehicle, there are two types of components: core automobile components, non-core automobile components. Core automobile components means the components without which the vehicle will not run. Non-core automobile components means even though they are not there, still vehicle will run. Car is there, side mirrors are not there. Even the side mirrors are not there, still car will move. So whatever the side mirrors are there, they are called as non-core automobile components. Gearbox is there. Without gearbox, car will not move. Gearbox is core automobile component. So what's happening? Indian company is exporting core automobile components to non-resident associated enterprise. There is one condition. What is the condition? Whatever the total turnover of Indian company is there, out of total turnover of Indian company, minimum 90% of turnover should be by way of sale of first-hand cars or sale of original equipments, not replaced parts. If this condition is satisfied, and if it is exporting core automobile components to non-resident associated enterprise, minimum 12% operating margin is required to be maintained. Then whatever the actual price is there, that will be considered as arm's length price. I hope you got clarity. Next, receipt of low value adding intra-group services. If support services are provided by one or more group members to others, then minimum how much margin is required to be maintained? Cost plus maximum margin allowed is 5% and together value should be less than or equal to 10 crores. What do you mean by this? First, what intra-group services means? Intra-group services means accounting support. Next, general ledger support, routine tax compliance support, secretarial support, payroll administration, HR administration. That means if these type of services are provided to your non-resident associated enterprises, then whatever the amount it costed to you, minimum that amount plus maximum 5% margin you have to collect from your non-resident associated enterprise. Then only that price will be acceptable arm's length price. Are you able to understand? So if low value intra-group services are provided to non-resident associated enterprise, minimum how much margin? Like cost plus maximum you have to add 5% margin, and overall transaction value should be less than or equal to 10 crores, and CA certificate is required to be produced. Then only safe harbor rules are applicable, otherwise safe harbor rules are not applicable. Okay. Next, I have to explain one last concept, specified domestic transactions. Once I explain this concept, we are done with theory part. Then from tomorrow onwards, we are going to solve problems. Now, what do you mean by specified domestic transactions? I'm going to explain with one example. There is an individual, his name is Ravi. He has two units. One unit in SEZ area, another unit in non-SEZ area. Unit in SEZ area, P&L account is like this. Expenditure 90 crores, sales 100 crores, net profit 10 crores. In non-SEZ area, in P&L account, sales 190 crores, expenses 100 crores, net profit 90 crores. So this is genuine transaction. But if genuine transaction is shown, they have to pay tax on 90 crores. Whatever the profit in Caesarea is there, on this profit there is no tax. So they have to pay tax on 90 crores. Will they show interest in paying tax on 90 crores? Of course, they will not show interest. So what they are going to do, they are going to manipulate the transaction. How they are going to manipulate the transaction? See, I'll explain. They'll prepare P&L account like this. Expenditure. They are going to book higher expenditure in sales area. Sales 185 crores. How much is net profit? Sorry, they are going to book lower expenditure in sales area and higher profit in sales area. So most of the profit will become non-taxable as entity is located in sales area. So how much is the net profit? 95 crores. And if you take P&L account of non-sales area, sales 190 crores, expenses 185 crores, they are going to book net profit of 5 crores. In this way, they are going to manipulate. So, what department is saying, whenever there are transactions between two entities located within India, one entity is located in CES area, another entity is located in non-CES area. Even for these transactions also, transfer pricing provisions are applicable. Are you able to understand? So, whenever one entity located in India does transaction with another entity located in India only, but in CES area. So, in between, in transactions between CES area and non-CES area also, transfer pricing provisions are applicable. Those transactions will be treated as specified domestic transactions. Are you able to understand? But there is one condition. If value of specified domestic transactions are more than 20 crores, then only transfer pricing provisions are applicable. Otherwise, transfer pricing provisions are not applicable. Are you able to understand? One more thing. Let's say there is a person. Let's say there is a person with the name Premo. He has two companies. Company 1, company 2. Company 1 is paying tax at the rate of 30%. Company 2 took the benefit of 115 BAB, 115 BAA, and it is paying concessional tax rate of 15% or 22%. Whenever transaction is done between these two companies, that transaction will also be treated as specified domestic transaction. That means one company do transaction with another related entity, that another company is paying tax at concessional tax rate of 15% or 22%. Even those transactions will also be treated as specified domestic transactions. You can see any transaction referred in section 80A, section 80IA, or referred in 115 BAB, manufacturing companies, and 115 BAE, all. So whenever you do transaction with Caesarea, and whenever you do transaction with a company which is related and it is paying tax at concessional tax rate of 15%, 22%, even those transactions will also be treated as specified domestic transactions. And for specified domestic transactions, transfer pricing provisions are applicable only if aggregate value of specified domestic transactions are more than 20 crores. Then only transfer pricing provisions are applicable. Otherwise, transfer pricing provisions are not applicable. With this, we are going to conclude the theory part. From tomorrow, we are going to solve problems of transfer pricing.